The two things I would call out this morning, one is, and we've got a slide in our macro themes deck, slide 38. Just to circle back to yesterday's number out of the conference board, the LEI, Leading Economic Indicator series. So this series is interesting. It's trended down again in October. The last time we showed it in the deck, we showed it through September. It was running at about a level of 105. As of yesterday's number, it's a level with a 103 handle, 103.9. It's been trending lower for a long time. This, I think, is the 20th consecutive month. It really peaked in sort of early 2022. It's obviously been trending down for a long time. I was curious just to go back historically and look at prior periods where, it had been trending lower for a long time. So interestingly, in the lead up to the GFC in early 2006 is when the LEI series peaked. It took well into the 20 plus month time frame for things to really get sort of going. So it's certainly not without precedent. And that's kind of the point. So this series continues to deteriorate. A lot of the core components, pretty diffuse deterioration here yet again in October. So, just continuing to measure and map, obviously, as we do in our stochastic nowcasting process, but also looking at, these guys, their framework, and historically what that duration, I think they call it the 3Ds, what is it, depth, duration, and diffusion. So how long is the cycle pulling lower, by what degree, and across what breadth of metrics? So
LEI analysis is always interesting. We do have at least one slide, if I recall correctly, in that almost 200 slide deck, just highlighting that and where we're at. It's just ongoing, right? So the difference being that is more tethered to the industrial or old economy, manufacturing economy, whereas right now you have something that's not a new part of the U.S. economy. Government spending has always been a big part of the economy, but certainly in rate of change terms, government spending has taken the baton in the year 2023 on rate of change. So it's just, government spending can delay what are traditional cyclical indicators, right? And that's not been able to do so in Europe. Europe's already entered a recession. China's in an industrial recession, in a broadening recession. And we go on and on and on. I think that, when you look at the bond yield signal here, the U.S. 10-year yield, whether you miss it by 3 or 5 basis points, doesn't matter. I mean, 440 is the level, and the long-term tail risk number is down closer to 4.01, I think. So I think what could happen here, or should happen, is that the 10-year can stay downward dog, but not break tail. So it's going to be between 4 and 4.5%. And that's it. Like, I don't think people are set up for that. I think everybody's set up for the old model, which is, oh my God, bond yields are breaking down, buy tech. I mean, that works, by the way, in quad 3 and quad 2, which monthly is what we had. But in 10 days, we won't have. So I just think that it's becoming very clear. I mean, that's essentially the trifecta this morning. You have oil down another percent, bearish trend. Energy, I shorted that yesterday, XLE. I didn't do it in real-time orders because it wasn't at the top end of the range, but get over yourself if it bothers you. We've been talking about it. It says bearish trend every day in a risk range product. So you knew where that was. And bond yields, which I just outlined, and then gold. Like the big three that a spy monkey wouldn't talk about, bond yields, gold, and oil, are all doing quad 4 right now.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.